Short selling explained in the simplest way possible. Short selling is a trading strategy where you can make money when a stock's price goes down, instead of up. It's not as common as regular buying, but many traders use it to profit from falling stock prices. However, it comes with its own risks. Let's break down how short selling works in the simplest way possible. What is short selling? Short selling is a trading strategy where an investor borrows shares of a stock and immediately sells them, hoping the stock's price will drop. Later, the investor buys back the same number of shares at the lower price, returns them to the lender, and pockets the difference as profit. How short selling works. 1. Borrowing shares. The investor borrows shares of a stock from a brokerage firm or another investor. 2. Selling the borrowed shares. The investor sells the borrowed shares in the open market at the current market price. 3. Buying back, covering the short. Later, the investor buys back the shares to return them to the original lender. 4. Profit or loss. The profit or loss is the difference between the price at which the shares were initially sold and the price at which they were repurchased. Example of short selling. Let's assume an investor believes that a stock, currently trading at 1,000, will drop in price. 1. The investor borrows 100 shares of the stock from a broker. 2. The shares are sold for 1,000 each, generating 1,00,000. 3. A few days later, the stock price drops to 800 as expected. 5. The investor buys back 100 shares at 800, spending 80,000. 6. The investor returns the shares to the broker and keeps the 20,000 difference as profit. If the stock price rises instead of falling, the investor will have to buy back the shares at a higher price, resulting in a loss. Why do investors short sell? 1. Profit from falling prices. If an investor thinks a stock's price is too high and will drop soon, they use short selling to make money as the price falls. 2. Hedge against losses. Some investors use short selling to protect their portfolio from a potential market downturn. 3. Market efficiency. Short sellers help bring balance to the market by betting against overhyped or overvalued stocks, thus contributing to price corrections. Risks of short selling and limited losses. If the stock price goes up instead of down, you could lose a lot of money. There's no limit to how high a stock can rise. Margin calls. You need a margin account to short sell, meaning you're trading with borrowed money. If the stock price rises, the broker may ask you to deposit more money to cover potential losses. Short squeeze. If many people are shorting the same stock, and the price suddenly rises, they may rush to buy shares, which pushes the price even higher. This is called a short squeeze. Short selling versus traditional investing aspect. Short selling. Traditional investing. Buy/sell sequence. Sell high, then buy low, expecting price to fall. Buy low, then sell high, expecting price to rise. Profit from decline in stock price. Increase in stock price. Risk. Unlimited, as stock price can rise indefinitely. Limited to the initial investment. Costs. Borrowing fees, margin requirements, interest. Transaction fees, potential holding costs. Time horizon. Typically short term. Can be short or long term. Famous short selling examples. 1. The Big Short, 2008 financial crisis. A famous example of short selling was the bet against the U.S. housing market by several investors, including Michael Burry and hedge fund manager Steve Eisman, during the 2008 financial crisis. These investors shorted mortgage-backed securities, profiting when the housing market collapsed. 2. Domestic short squeeze, 2021. In 2021, retail investors on Reddit's Wall Street Bets triggered a short squeeze in Domestic, a heavily shorted stock. The stock price skyrocketed, causing massive losses for institutional short sellers and drawing attention to the risks of shorting. Should you try short selling? While short selling can be a way to make money from falling stock prices, it's risky and not for everyone. If you're new to investing, it's generally safer to stick with traditional buying and holding stocks for long-term gains. Short selling requires close attention to the market and a good understanding of how prices move.